Before we understand central banks, we need to understand money. Because money isn't actually paper. It's trust. Imagine Walter receives his paycheck. He accepts it because he trusts it can buy food tomorrow. The grocery store accepts it because they trust suppliers will take it. The supplier accepts it because they trust their workers will take it. The workers accept it because they trust everyone else will too. Money is simply a giant chain of shared belief. And when that belief breaks, everything breaks. History taught governments this lesson repeatedly. Again. And again. And again. Eventually they realized something uncomfortable. Trust alone wasn't enough. Modern economies needed a referee. Someone to protect the system itself. That referee became the central bank. Imagine the entire economy as a tightrope walker. On one side is inflation. On the other side is recession. If the walker leans too far toward inflation, prices rise. Savings lose value. Life becomes more expensive. If the walker leans too far toward recession, businesses struggle. Jobs disappear. Growth slows. The central bank exists for one reason: keep the walker balanced. But balancing an entire economy isn't easy, especially when millions of people are making decisions every single day. So central banks rely on one surprisingly powerful tool: interest rates. Most people hear the words interest rates and immediately lose interest. But that single number quietly affects almost everything. Think about Walter again. Suppose Walter wants to buy a home. When interest rates are low, borrowing becomes cheaper. Walter can afford a mortgage. Businesses can afford expansion. Factories buy equipment. Investors take risks. Money flows. Growth accelerates. The economy levels continue rising. Populations are aging. Global tensions are increasing. The economic rulebook that worked in previous decades may not work forever. And nobody knows exactly what comes next. Not politicians. Not investors. Not economists. Not even central bankers themselves. Thermostat controlling the temperature of an entire nation. Lower the temperature too much and everything freezes. Raise it too much and the system overheats. One morning Hans receives his wages. Not in an envelope. In a wheelbarrow. There are simply too many banknotes to carry. The moment he receives his pay, he runs to the nearest store. Not later. Not after work. Immediately. Because every hour his money becomes worth less. Bread prices double. Then double again. Savings disappear. Lifetimes of hard work evaporate. This is hyperinflation. And it is one of the most destructive economic disasters a country can experience. Years later, Zimbabwe would experience a similar nightmare. Trillions printed. Yet barely enough purchasing power to buy basic necessities. This is the nightmare central bankers never forget. Because inflation doesn't destroy money. It destroys trust. And when trust disappears, everything else follows. So what happens when inflation becomes dangerous? Central banks raise interest rates. Borrowing becomes harder. Spending slows. The economy cools down. Sounds simple. Except it isn't. Because raising rates too aggressively creates another problem. Businesses stop expanding. Hiring slows. Unemployment rises. Growth weakens. Every central bank faces the same impossible choice: fight inflation or protect growth. There is no perfect answer. Every decision is a prediction about the future, and the future rarely sends warnings. Imagine being a doctor treating a patient. The medicine can cure the fever, but too much medicine creates a different illness. That's the challenge. Every day, every year, every decade. Banks had issued enormous amounts of risky housing loans. When homeowners began defaulting, the losses spread everywhere. Banks stopped trusting one another. Credit markets froze. Businesses couldn't borrow. Families couldn't refinance. Jobs disappeared. Homes were lost. For a moment, the global economy seemed dangerously close to collapse. This is when central banks reveal another responsibility: the lender of last resort. When nobody else is willing to lend, the central bank steps forward. Not to save individual banks, but to save the system holding everyone together. Because if the financial plumbing stops working, the entire economy can shut down. By 2008, another problem appeared. Interest rates had already fallen close to zero. The usual tool no longer worked. So central banks tried something extraordinary: quantitative easing, creating new money digitally and using it to buy financial assets. Supporters argue it prevented another Great Depression. Critics argue it increased inequality and boosted asset prices. Even today, economists continue debating whether it was the right solution. The argument isn't over, and it probably won't be anytime soon. Here's something many people find surprising: the people making these decisions are usually not elected. And that's intentional. Imagine an election approaching. A politician might want lower rates, more spending, more growth, a stronger economy today, even if it creates inflation tomorrow. To avoid that temptation, most countries separate monetary policy from politics. Central banks are given independence, not because economists are always right, but because somebody has to think beyond the next election cycle.